Hey, good afternoon, everyone. Welcome to MarketStream. This is the closing bell on July 7th, 2017. My name is Joseph Cusick with the Cusick Group Securities offered by Money Block. And I want to wrap up today's action. I know we haven't been on most of the day. I've been working on some projects, and there was quite a bit of trade going on today. So I'll just want to kind of wrap up today's action, give you some context going into the weekend. First trading week of July, and it was interesting action. And really where I want to start is volatility. We actually saw a little bit of two-sided action early this week, and it basically tapered off as we started getting into the end of the week. Now, vol was up right around 12.50 yesterday on the close. It came down about a buck and some change, down 10% at 11.20. Like I said, it's historically low, but this is notable. The overall market volatility, it's low, but you're starting to see it pick up. So in other words, the implied volatility ranks that I mentioned, for example, for the diamonds at 23, we were talking about that yesterday, or the S&Ps at 16, now up to 23 or 22. The Qs, IV rank of 57. The small caps, the IWM or Russell 2000 at 25.21. And TLT at 23. That's the bond ETF. Now, you hear all these numbers, and basically when you see it get into the 20 range, you're still in that lower third. So there's not a heightened expectation of big violent moves, but they're starting to get up off of where they were, which was in the teens or single digits. This is at least welcomed information, because it allows us now to better understand what are the strategic approaches to take, rather than just being long or short underlying assets or asset sectors or asset classes. So with that being said, let's drill down what happened today. I'll give you a few pieces of food for thought going into the weekend and what you could be looking at for next week. Taking a look at the Dow Jones, you saw it challenge its 20-day moving average. The bulls are still in control here, folks. There's been a lot of positive data. The employment data was positive. The claims were lower and still below any historic significant level, under 300,000, actually under 250,000. You saw the employment numbers come out, solid. You're seeing some economic data come out. Here's what I didn't like today about the data here in the States. And this is where it's a little bit of a yellow flag. Wage inflation. It's non-existent. I know I've been harping on this, and I shouldn't be stuck on one piece of data, but without wage inflation, I just don't know how the consumer or the consumer discretionary market is going to hold up. Now that we're getting into the tail end or the middle of summer, so you get a little bit of a doldrums, there's not, and you're getting, people thinking about school starting up, believe it or not, in another month and a half. Boy, my kids' ears are probably burning right now. But I didn't like that number. Now, the Dow held up despite of that, and I'm going to watch this very closely. There was real low volume on this move to the upside today, and you can see that the market has just been grinding in the Dow. What's also been holding up the Dow is the performance in the financials, which continue to move to the upside with the pullback in the bonds, which we'll talk about in a minute. The S&P 500 also heavily influenced by finance, also has some influence by tech, specifically biotech is a big mover in there, as well as some other offensive sectors like the consumer discretionary. Take a look at those areas, and you'll start to see that there's a little bit of pickup, especially in the retail and consumer discretionary. They've been beat up. Maybe not so much the discretionary, but the retailers, they're starting to bounce back a little bit. Let's see if that holds. What is notable, though, is take a look at the spiders right in between the 20 and 50-day moving average. So the battle has begun in the S&Ps. We didn't see that in the Dow. It's just hovering right above or at its 20-day moving average. The S&Ps are now in between the 50 and 200-day moving average. For those of you that are first watching, this is an area that if you start to see the market trading in it, that means that whatever the current trend, in this case the bulls to the upside, that is under pressure right now. Now, today's action took some of that pressure off because it did settle below that 50-day moving average yesterday. But for the week, we still are starting to see that that pressure is building, and we're going to watch that very closely. One area where the pressure has continued to stay is in tech and NASDAQ. Now, large cap tech, as we discussed, the FANGs, the Facebook, Apples, Amazons, Netflix, Googles, they all improved today. You can see the performance, but they're below and settled below their 50-day moving average, and they've been below their 20-day moving average. There is an air of potential uncertainty in this realm. Profit taking with the lower wage inflation. Bottom line is that I think at this juncture, you're starting to see a lack of momentum on the stocks that have basically been carrying this market on its back. Watch that one very closely. The Qs right now are running at the highest implied volatility rank out of all the major indices. The NASDAQ is at an IV rank of 57.2 or something around that level. What does that mean to you? That means expect the potential for big violent moves. And this is actually extending out longer than you normally would see. When you see an IV rank get up into these levels, volatility is an instrument that will revert back to its mean. So when it gets above its average, which right now it is above its average as far as IV, be aware. This means that there's the potential for violent moves, and you've seen the potential. It's actually shown some pretty decent ranges. Now, it tightened up over the last 3 sessions, but tech is under pressure. We're getting into the earnings season. This is where we're going to have to watch the sector, and this is for those of you that are premium sellers as far as options traders, and there's a bunch of you that are watching that are pretty sophisticated, so I appreciate you chiming in. This is an area that you're going to see an opportunity to put some premium selling strategies to work. And we haven't been able to do that in a while. The Russell 2000, which in full disclosure, I do have my clients exposed to. The rut actually finished up, and this was one of the better performing, other than tech, this was the best performing index in sector and segment of the market, up 15. But what's impressive here is that it broke through its 20-day moving average and held its 50-day moving average over the last 2 sessions. Markets were looking weak. There's been some pretty decent ranges in the small caps, but watch this one. Without having wage inflation, we're going to be watching the data. If in fact the Fed maybe makes some tone changes in the next couple of weeks because the data might come out mixed, that's where we could see that the market could actually shift it. Also, let's see how after the president gets back from the G20, what's going to happen here with his agenda? We want to see this agenda start to move, and we don't have health care, we don't have tax reform, we don't have anything really at this juncture that's been implemented, and this is what the core of this rally has been based on. And you know what? You could see that since nothing has happened over the last couple of months, a failed tax reform bill, a failed, or so far, a stagnant healthcare replacement and reform. Nothing there. And we've had no infrastructure. I'm living in a state where basically we haven't had a budget in 3 years, and projects haven't been paid for and bills haven't been paid for in 3 years. Wish I could do that. But where we have been seeing a lot of volatility is crude oil. And crude oil has been moving. And as I have said for weeks, even when it was trending at 48 or 52, I felt more like the sweet spot for crude is in this $44 level. And you saw that the crude contract did finish the day down 98 cents. And that was good for 2% at 44.36. This, I believe, is going to be that area or zone that the bulls in crude are going to have to hold or start to gain some control. It's clearly in a bearish trend. There was a potential for a rally, but that was squashed pretty quickly after an EIA report came out, which was interesting. Yesterday, there was a larger than expected draw from the storage in Cushing, Oklahoma, but it was a little over 6 million barrels. We also had a draw in gasoline and also distillates. What was interesting, though, is that the market got spooked when all of a sudden they saw that the U.S. production still is ramping up. In other words, we're still sucking out as much of this crude as we can at this juncture with what's online as far as rigs. And this is interesting, folks. We are not making a dent in the storage. Even though we had a bigger draw this week, and we've seen some draws over the last few reports. Bottom line is we're not seeing a dent in the supply. That has crude in the $44 level, and that's where I think it's going to waffle around and trade around for the foreseeable future. In full disclosure, I do have my clients in crude positions. Where we did see some big pullbacks as well in the commodity space was gold. Gold continues to struggle. We've talked about this. I think gold is, once we saw it break in June below that 1260 mark, that was a critical level that needed to be held. It didn't hold, and gold has continued to get weak. There is no really either inflation or fear bid right now in gold, so the pullback makes sense, but we'll have to watch this very closely. Where we did see a pullback, and this is what I said watch, is the non-ferrous industrial metal copper. Weakness in copper kind of puts any type of infrastructure, basically puts some growth plays as far as economic growth, maybe a little bit in jeopardy. Now, of course, we'd like to see it above that 265, 264 level, even in that 270 level where we saw it in the beginning of the week and the end of last week. But with that being said, now challenging that 263 and then looking to potentially challenge the 260 level, that's going to put a couple rallies at risk, and specifically not only in the rally in copper itself, but this will also put some pressure on the Russell 2000, that small cap index that's domestically centric, and it's focused on growth here in the United States. If there is any type of blip on that growth radar, copper could be tipping its hat. A break of the 20 and 50-day moving average to the downside puts the copper bulls on notice, on their heels, and that could also be a red flag for any move to the upside. Bonds continuing to get hammered. Not to say that this isn't a complete shock, because it's not, but bonds right now are getting into that 122 level on TLT, which is a hybrid between the 10 and 30 year bonds, the longer end of the curve. But this is an area where you're going to want to watch very closely. It's broken its 20, its 50, and its 200-day moving average. Bond bears are in control, folks. And let's see if this actually firms up. You're looking at the 2-year down 0.5% again today. The 10-year was a little bit more muted, basically trading flat around 99.29. And you have the 30-year down 0.3%. Almost 0.4%, but again, off of its worst levels. But really where you want to see if the resistance is going to start kicking in bonds, you're going to notice it if you cannot get yields above 2.4%, which they've been screaming right now, finished at 2.38%. This has been a 2-week run up in yields, which has been a huge positive for finance. But if we can't get above that 2.4% with conviction, that could put the bonds a little bit of jeopardy of basically maybe gaining some traction, especially with any headline risk or any economic data that might come out. As a matter of fact, as I had said, if you take a look at XLF, they have utilized this bond pullback as an area and a time where they can start to firm up. This could be the next leg, especially now that we're getting into earnings season. Let's see how these banks actually come out with their numbers. That's going to move not only the S&P 500 and the Dow Jones, but it could potentially be a pretty significant catalyst for the small caps as well, since a huge portion of the small caps, that Russell 2000, is in the banks, and especially with the regionals. So we'll keep a look at that, and we will, over the weekend, I'm going to put out some videos, put some short pieces out there that will talk about some strategic approaches that you all can utilize for whether it's big accounts or small accounts. And if you're a little worried and you want to put some capital to work, but you want to hold cash, because I'm using cash as a position right now as a vehicle, I will show you some of those different strategies. We're going to put little 3 to 5 minute pieces together. Check them out on MarketStream.live, or you can go to our Facebook page, MarketStream, on Facebook. All right? Well, folks, have a great weekend, and we will see you back here next week for our second trading week in July. So have a great weekend, and we'll see you here at MarketStream.live. Thanks.